All right, thank you. Good afternoon. You're here to see the panel about tokenized securities. I'm Scott Robinson, founder and advisor at Plug and Play FinTech. For those of you that don't know Plug and Play, we've been investing in startups for the past 25 years, so names you might know include PayPal, Lending Club, and Dropbox. I led the FinTech activities there, so I did about 52 investments. A lot were in the blockchain space, so you may hear a few names that are familiar. It's good to see Justin from Netkey. We also did Provenance, Civic, Factum, Nuco Aeon, and many more. Today, we're very excited to talk about one of the biggest, I'd say, shifts in sentiment as it relates to one of the big moves in the market relating to ICO. So if I could just have your attention for the next about 30 minutes. We have an esteemed group of panelists here, so I'll let them introduce themselves. So starting with the first gentleman to my right.
Hey, I'm Rafael. My background is on the engineering side. I got into coding in middle school and then went to Stanford to study computer science. And while I was there, I got very interested in cryptography and also AI. And I had a chance to work at Palantir doing AI research for crime prediction, and then later at Google Brain. And then at the end of 2016, I left Google and started the company TrustToken with my two co-founders, who are old friends of mine. And our focus is not just on creating tokens that are securities. Our focus is on connecting assets to blockchains more generally. And so our first product that we announced about 4 or 5 months back is called TrueUSD. It's listed on Binance, Bittrex, Upbit, Cryptopia, HitBTC, a bunch of the large exchanges. And it's a stable coin that's backed one for one with real US dollars. And we're going to be launching other currencies such as True Euro and True Yen coming up later this year. And then down the road, connecting other kinds of assets such as commodities, equities, real estate, bonds to the blockchain. So that's what we're about. We're called TrustToken. And you can find us online at trusttoken.com.
Hi everyone, Jay here, Jay Thakrar from Consensus Token Foundry. We are the tokenization arm of Consensus. Token Foundry basically has two sides to the business, or two pillars. We have a utility business and a securities business. On the utility side, doing everything from incentive system engineering down to structuring sales and raising capital. And then on the utility side of the business, we do have a broker-dealer, predominantly focusing on primary issuance and thinking through sort of the secondary trading of those assets. Within Consensus, and additionally, there's several other fantastic projects such as AirSwap and Radio that are also thinking through primary issuance, secondary trading, as well as tokenization of real estate.
I'm Joshua Stein. I'm the CEO of Harbor. Harbor was founded to tokenize traditional private securities. So think sharing a private company, LP interest in a fund. Harbor is a platform plus a protocol. It's a platform for onboarding the investor and issuer, issuing that security token, and then it's a protocol that governs the compliance layer for how that security token trades later. So we govern the who, what, where of compliance, who the buyer and seller are, what the trade is, where it occurs. We're not an exchange. We are ERC20 standard tokens. We plug and play throughout the ERC20 ecosystem. My background is, as an attorney, I was a federal prosecutor for a while, and then I was in-house in a number of highly regulated industries.
Hey guys, my name is Nadav Hollander, and I am the founder and CEO of Dharma. Dharma is the generic protocol for issuing, administering, and originating debt instruments of virtually any shape and size on blockchains like Ethereum. We've been live on the Ethereum mainnet for approximately a month and a half now, have issued something close to around $70,000 in loans, and are expanding as we speak. And my personal background is, similarly, I went to Stanford and studied computer science there, fell in love with kind of the crypto space in early 2015, and worked as an engineer at Coinbase prior to starting Dharma.
Awesome, thank you. Well, I thought we'd kick it off asking the folks in the audience, who actually knows what a tokenized security is? Raise your hand. Fantastic. Okay, who owns one? Raise your hand. Yeah, you don't know what it is. So maybe, Josh, you could hit us off with, what is a great example of a tokenized security at this point that you're seeing in market? Or are there some examples that you might speak to?
So there's not a lot out there. So think of a traditional private security. You own a share in a private company, say a VC-backed company. You own a share in a private REIT. That's a C Corp with special tax treatment because it invests in real estate. An LP interest in a fund, like a VC fund or a private equity fund. Those are traditional private securities. They are, you guys are all familiar with the Howey test, and people get confused between that and utility tokens and are they or aren't they securities. I would just really distinguish between a utility token whether you have to treat it like a security under the rules or not. That utility token is a payment service and relates to a protocol versus a security token, which is simply a token that represents a traditional private security interest and has a very defined economic and legal meaning.
Thank you. And I guess I'll pass this to you, Nadav. What are some of the traditional challenges from a technical level with securities that you've seen in the past? Or maybe another way of asking that, what are some of the advantages that you see with this kind of new order of security?
Right, so I think like if you look at the way that securities are generally administered nowadays, like Wall Street has kind of evolved this whole cottage industry of different intermediaries and clearing houses and you name it to essentially kind of like service the trading of these instruments. And while certain instruments trade in like a very efficient manner, like, you know, like the most obvious example being like stocks, there is just this huge class of instruments that are like real estate or derivatives or certain classes of debt, et cetera, a lot of which are like largely traded over the counter. And a big reason for that is because like there's just so much like institutional inertia and friction around like how do you actually disperse payments and keep track of who's actually like on the cap table, like all these things that right now work because there are things like paying agents and there are things like clearing houses. But they don't work as well as they could, right? And so I think that's why it's really important that you can suddenly have this kind of like single source of truth that people can use to track the ownership of an asset, and where it becomes very, very easy to like create an asset on that single source of truth. That really radically opens up possibilities for how liquid markets, which are previously relatively illiquid, can become.
Anybody else care to join in on that?
So I think the question of what are the advantages of tokenized or securities that are tokens, a more general question is just what's the advantage of holding any asset in token form? And in general, it looks to me like there are three advantages. The first is liquidity, because when you put an asset in token form, that's like an open source and electronic version of the asset, and so that can immediately be plugged into many different exchanges, and many people around the world know how to hold and trade tokens. And so you can plug into a very large ecosystem immediately. And if let's say you list something on the New York Stock Exchange or on NASDAQ, even though those are some of the largest markets in the world, you're still limited to that specific geography and to that specific market. And the assets aren't easily interoperable between those different exchanges. And there's also infrastructure that you get for free, because when you put something in token format, now, let's say like ERC20, there are lots of different applications like, derivatives and DEXs and so on that can immediately plug into. And then I'd say the third is security, because when you own a token, you know you really own it. There isn't any sort of centralized server where if that were to be hacked or go down, you lose access to your property.
Thank you. And kind of shifting gears, Jay, a question for you. I guess maybe in the audience, who's building right now tokenized security or working on an ICO project? A few, right? So, Jay, you've seen a number of projects come through. What were some of the challenges you faced, both in discovery of the definition of a tokenized security, as well as what was the process for you in building out some of these projects?
Sure. I think one thing that we need to kind of take away is like it's still very early days out here. If we think through like sort of the consensus ecosystem, for example, Meridio's already tokenized a building in New York. They've done it through sort of a Reg D offering using an issuer exemption. But at the end of the day, I mean, number one, you have to think through sort of working through or understanding sort of the regulations behind sort of what type of offering you're going to facilitate. Number one. Number two, thinking through sort of like some of the transfer restrictions on that to see like exactly if it's going to be liquid or it's not. I think this sort of is related to the previous question in terms of like what actually is the benefit today of tokenizing, and I think it comes down to sort of providing transparency, eventually providing sort of liquidity premium or providing liquidity to a previous illiquid asset class, and at the same time sort of reducing the transaction costs. But at the end of the day, it's still early days where we haven't seen much out there. But within Consensus, for example, I know Meridio's done a fantastic job sort of already tokenizing one building itself. And then on the sort of primary issuance or secondary side of things, still things are being figured out around sort of if you issue a traditional security today, that's sort of step one. But step two, sort of thinking through actually tokenizing that security has sort of many different sort of implications or considerations around one, sort of the custody of it, to the actual sort of logistics of transferring it, and sort of the restrictions as to thinking through like the timing of it and how that all work.
Thank you. And Josh, what was it about real estate that was just so attractive to start off in the security space?
Yeah, so we didn't start with real estate started with us. I think the fundamental value prop for tokenization, the fundamental value prop of the blockchain, the Fundamental value prop of the blockchain is a recordation and transference of ownership, which is perfect for securities. So why does tokenization unlock so much value? It brings liquidity. It's easy to transfer ownership. So where you want to lock up the capital, not the investor, where you're sensitive to the cost of capital, but relatively indifferent to the identity of the investor, that's a great use case early on for tokenization. Real estate is that industry. They're very sensitive to the cost of capital. If you can get a 10% better cost of capital, that asset that's worth 100 million is now worth 110. Conversely, if you have to offer a 5 cap or a 5% yield, you now only have to offer a 4.5% yield. Those are big differences in the real estate world. I think you can, and so the offer of liquidity and the value it brings is a big deal. And liquidity is going to be there because they'll take any legal investor around the world, so you got a big pool of liquidity. I would draw a contrast to what's not a good first use case for tokenization, high-tech startups in Silicon Valley. And I'm serious, you could tokenize your shares as a gimmick, but no startup that has any traction is going to let investors trade in and out of their cap table, right? A startup that has traction picks their investors don't pick them, and they're certainly not going to let people around the world they don't know trade in and out of their cap table and have access to their books and records. As opposed to a real estate investment, private REIT, they're publishing their financials in a NAV every quarter anyway, and so they're just happy to get additional capital at a lower cost of capital from non-traditional channels.
That brings up an interesting point, and it's kind of timely. TrustToken's been listed on CoinList recently, and I imagine you're in the process of vetting a number of different things. So what are some of the considerations when looking at some of the infrastructure offerings out there in the process of building your ICO or your tokenized security?
Yeah. Well, I mean, we just listed our token, TrustToken, on CoinList, and that's a Reg D offering for accredited investors. And one of the reasons why we're partnering with CoinList is because they're a great platform for doing these very compliant sales. And so as part of a Reg D securities offering, you have to have a PPM and a SAFT and a variety of legal mechanisms to make sure that you're making the right disclosures to your investors and they know what they're purchasing.
I guess another way of asking is, Nadav, we saw recently Coinbase get some sort of approval for tokenized securities. Would that be an attractive place to land for your respective project, or what are your thoughts as it relates to something like that?
Oh man, so you're asking about the recent news that Coinbase essentially got explicit approval to have a broker-dealer that essentially can trade securities. Yeah, it's a huge deal. It's really a massive deal because kind of one of the biggest things that, at least in my opinion, has been a blocker on really seeing like a robust tokenized securities market, other than of course like the core infrastructure for it, is just like markets, like exchanges that are willing to like list these tokens, right? And there's some that are starting to come to market, and it's really exciting. But Coinbase is kind of like the big daddy here, and they carry so much legitimacy to their name that if they can kind of carve that path, whether or not they win the market, at the very least they've kind of proven that you can do this in like an above board way. And I think that once you have really good liquidity for tokenized securities, that kind of creates a virtuous cycle of kind of breaking this like chicken and egg issue. Because now it's like, oh, okay, now there's a really great reason why I should create a tokenized security because I have a really liquid market that I can sell it on.
Yeah, I'd actually just give a shout out there to some of the other compliant exchanges that are either licensed or getting licensed shortly that are coming out. A number of them are built on the 0x protocol, which we're really excited about. You can think about the Ocean, used to be called the Ocean X. You can think about Open Finance. There are others with different models that function more like dark pools. Think of like a Templum, which is also a qualified matching service. There's a great tech provider called Alpha Point. One of their folks is here. They're a tech provider across a number of exchanges around the world. I have talked to folks standing up exchanges in Hong Kong, Singapore, Australia, and the UK. And so, and I think I want to give a plug for decentralized exchanges. And the reason why is because there's a property to them as opposed to centralized exchanges that's really important. Two properties. One is they don't custody funds or securities. The other, though, is that you can have one worldwide pool of liquidity. So today, if you list on the New York Stock Exchange, you're not trading on the Frankfurt Stock Exchange. You're not trading the Chicago Board of Exchange. With a decentralized protocol, you can have an exchange in Singapore with a buyer, another exchange in the US with a seller. It's one worldwide pool of liquidity, and the trade crosses, which is really incredible because exchanges are a ton of work. There are some people out there that think that they're going to be the whole tech stack. They're going to be the issuing platform and the investment banker, and they're going to do distribution, and then they're going to be exchange, and they're going to do the whole 9 yards. It's a pipe dream. That's a very complicated tech stack. It's a very complicated business model and relationship stack. It's a very complicated regulatory stack that you then have to replicate jurisdiction by jurisdiction, and the only thing that transfers is part of the technology. Everything else, you got to redo. And so the idea that you can have an exchange in Singapore with its own relationships with broker-dealers, market makers, investors, its own relationships with regulators, can then aggregate orders with an exchange in the US that does the same thing is incredibly powerful. And the near instantaneous settlement with no counterparty risk and no intermediary to custody, I just think is a really important point. So it's great to see a number of exchanges springing up. I just wanted to really plug the decentralized model.
You mentioned custody a few times, and I think that's a pretty important topic. I mean, from our experience at Plug and Play, we had made a number of investments traditionally into equity, and you can imagine at the event for which an ICO occurred, or revenue in this case may have been defined as that token raise, there were a lot of challenges for our accounting team. So question posed to the entire group of panelists, what are the implications for the investor, and what are some of the new challenges the investor faces? I could say for number one, actually setting up a Coinbase account or some sort of wallet in my accounting team was pretty difficult. So how are you attacking this problem?
Yeah, so I mean, I can talk a little bit about this. You know, we were having kind of a little conversation in the hall previously about this, and I shared an anecdote about how, you know, my family has seen me get into this crypto industry thing, and they're like, oh, you should invest in cryptocurrencies for us. And I'm like, okay. And as soon as I try to figure out some sort of like custody solution, I'm like shocked to see that like, it's like there's just not good service providers yet for these sorts of things. There are some, but like not necessarily for like the average retail investor. And so, you know, I think there's huge room for growth there. I'd say that probably people have different answers on this like panel or on this like on these chairs here in terms of like how they're dealing with it in their particular context. For us, we've just been focused a lot more on investors that are like very comfortable with the cryptocurrency ecosystem. Like we're more focused on crypto native use cases for debt in general. So the investors that we're targeting aren't necessarily going to blink twice about installing MetaMask and custodying their own keys. But that is only going to take us so far, right? And I think that what's going to be really important is seeing like really good generalized key custody solutions really break into the market. And I think that that's going to open a lot of doors for pretty much everyone on this panel here.
So I think you can think of custody on 3 different levels. You can think of it on a legal level. Certain institutions, funds with greater than 150 million assets, have to use what's called a qualified custodian. That's a designated legal standard. You can think of custodianship in terms of the practicalities of it. People just don't want to manage their keys, and they lose their key, and they want to do things the old-fashioned way, pick up the phone or send an email. And then you can think of it in terms of the security, where you're concerned about getting hacked and losing the asset. On the last one, I think what's important to note is security tokens are very different than cryptocurrencies or utility tokens. The risk of loss is completely different. If your wallet is hacked and you lose your Bitcoin, you have lost the asset. If you lose $1 million in Bitcoin, you're out $1 million. If someone hacks your wallet and takes the security token representing $1 million in shares, the asset hasn't gone anywhere. The company is still there. The piece of real estate is still there. All there is in the great ledger in the sky, it used to say Josh 100 shares and Nadav 0, but Nadav hacked me. Now it says Nadav plus 100 shares, Josh minus 100. The fact is you just move the shares back. Any security token solution that's compliant has to have the ability to move shares around, because a company has to always know who are what's the true identities of the people that own those securities, and they have to have the ability to assign ownership. There's a court order that says assign ownership of 10 shares from Josh to Nadav. You have to be able to do that. And so as a result, that security token vendor in a multi-sig situation, in accordance with the issuer, then simply reassigns. You move the 10 tokens back, but you always know the real world ID. The asset hasn't gone away, just simply the recordation. There's another record that showed it moved from one person to another. Anybody that's hacking security tokens to try and steal them is committing like the completely imperfect crime, because they've left a perfect record of what they have and someone's about to take it back and then send them to jail.
Thank you. Any other comments on that?
No, I think Josh brought up a really good point. I think on the custody side of things, though, I think there's still a lot of logistical things I need to kind of take into account. You know, thinking through sort of where these assets are coming from, understanding sort of your customers, doing the AML verification of that, and making sort of tying all these sort of compliance regulations into some sort of like custody function, I think is stuff that still has yet to be figured out. But these are all important considerations. But I do think that at the end of the day, you still have your underlying asset, and that's sort of not going to go away. So it's just a function of sort of adjusting the records accordingly. And there's multiple ways that you can handle it. So just my 2 cents on that.
And now maybe flipping the table, taking a negative paradigm on this concept, what are the disadvantages or friction points that come with tokenized securities to the general audience here?
I'd say the UX right now, it's just clunky. I mean, like Nadav, right? I try to take a family member through the process of setting up a MetaMask wallet. And MetaMask is great, and it's probably one of the most user-friendly wallets out there, but it's still a blow-your-brains-out experience. And the idea is, if you think about tokenized securities, who are the investors? The investors are people between the ages of 50 and 70. My parents still won't buy anything from Amazon.com because they don't want to put their credit card on the internet. So you're going to have a tech adoption curve just like you have in any other industry, and you're trying to penetrate the people, the institutions, and the individuals that have the money to invest in these assets are on the older end, less technologically sophisticated end. Early adopters will be the tech enthusiasts, people early in crypto, but we need to improve the user interface, improve the user experience. The point at which people no longer talk about a crypto security or a security token, when they just call it a security and they have no idea they're interacting with crypto, that's the moment of mass adoption.
Any points, or I know there's a lot of entrepreneurs in the audience, so any best practices or thoughts in your history and experiences in building these projects? Anything you would want to part with to the entrepreneurs in the audience?
Launch, like actually ship something. Because I think there's like a lot of, it's really easy to fall in this kind of trap in this space right now where like you get funding because there's a lot of money floating around. And you kind of like enter this endless cycle of building proofs of concepts and then you die. And I think that like a lot of like, you know, there's like so many like just common lessons that like people have like learned in the like normal startup industry that for some reason haven't like osmosis over to like the like crypto startup industry. And like the most important of those is that like you should launch a minimal viable product as soon as like securely possible to like as many people as possible, because like the vast majority of the assumptions you're making are like probably false, and you'll probably need to update them, and the only way you can actually get that is through feedback from the market.
Yeah, just to add on that, I would say another perspective or some advice would be, definitely engage sort of legal counsel early on in terms of understanding sort of the compliance requirements that need to get baked into the smart contracts. I mean, at the end of the day, the amount of redlining clauses and all that stuff that goes into actual legal contracts need to thoughtfully be included into smart contracts. So, I mean, your ERC-20 contracts, don't sleep on them. Engage sort of legal counsel as early as possible. Understand or be prepared for the fact that your smart contracts will likely be static to some extent, so they will need to be customized on a deal-by-deal basis, depending on the type of actual security instrument that you guys will be facilitating. So things like this are all considerations that I would say get ahead of as early as possible as you think through it.
I think one of the secrets to Coinbase's success was, I think it's employee number 9 was a chief compliance officer and 12 was in-house counsel, something like that. I know at Harbor we hired early for that. It's you can't be too soon with it. I think the other is just the general rule of startups that you have the rule of pi, which is particularly in the crypto space, everything takes 3.14 times as long as you think it will. It's 3.14 times as expensive, and you pull out 3.14 times as much of your hair doing it.
Yeah, I second what Josh says about compliance, and I think that whenever you're connecting assets to the blockchain, whether it's securities or anything else, there does inherently have to be sort of a centralized entity which is doing that connection, like whoever's holding or managing the actual asset. And one of the consequences of that is that trust becomes paramount. And so, at our company, TrustToken, we're also, we're only a team of 19, but we have an entire compliance department, and we hired a director of compliance who, has been the chief compliance officer at First Republic Bank and at Northern Trust. And so, we're already as a small company building importing a bank-level compliance program, and that's a huge amount of work, but it's hugely important because, anytime you are the one who's being the centralized issuer of tokens, backed by real assets, then all the token holders around the world need to be able to really count on you.
I've looked at thousands of startup pitches in this space, and I'll just add two points from my perspective. Number one, solve a real problem. Don't tell me about the blockchain critical mass you're going to get, and then jump from there to solving something. It's a big hiccup we've seen lots and lots of. And I think second is stay focused. We see a lot of folks boiling the ocean across multiple modular offerings. Solve the problem really well one way. But with that, any resources that you guys would point anyone in the audience to learn more, both about your projects or certain readings that might be relevant? I know I'm on Reddit a lot, Bitcoin talk forums, things like that.
I've actually found the biggest help is all the different podcasts. There's Unchained with Laura and a whole series of them. Because you could spend all day, every day just reading good quality stuff that gets written. And everybody's too busy during their day just trying to get through the day. And so I found the podcasts on the weekends and nights and evenings, or nights and mornings, incredibly helpful to stay on top of what's going on, because I think what's important is this is an ecosystem. The great part about a non-permission blockchain is that you have a platform that no one can kick you off of. You can develop a business and you're not at the whims of a Facebook or somebody else that's going to shut down your business. But it also means that you need to know what's going on with everybody else in the ecosystem in order to maximize your own value in what you're doing.
Oh, you go ahead. Okay, well, if these aren't blockchain specific, but if I were to recommend 3 books for entrepreneurs trying to do something in the space, I would say Principles by Ray Dalio, Getting Things Done by David Allen, and also the 7 Habits of Highly Effective People.
And just to add to that, I'd say one thing that's been extremely beneficial for us has been just openly having conversations with other players in the space. I mean, I can say in the last 10 minutes, I've definitely learned from, before this sort of panel outside, catching up with Harbor and with Dharma and TrustToken on like how they're thinking through things. I think it's really, really powerful. You know, we've had open conversations with a lot of other players in the space. I think we're all sort of trying to accomplish the same thing, and I think that's going to sort of come together with working with the regulators and educating them about how to think through this and sort of what we're trying to accomplish. And so having that open dialogue, I think, will go a really, really long way. So, you know, definitely feel free to leverage anyone in the space already that's doing stuff. You know, we're definitely very approachable on that front.
Yeah, I think the question started off around kind of like good sources of content or things to kind of get educated on. Yeah, just resources for this sort of stuff. I'm going to give a shout out to Token Daily. I think they're actually like a fantastic newsletter, and they really present content in like a very like accessible and entertaining way, but it's also like very educational. So if you're trying to like really get up to speed on like the pulse of the industry, I think that's like a pretty high signal source of information.
And I'll just add, I run the Silicon Valley Bitcoin meetup, so there's a lot of meetups here in the Bay Area and where you're from, so definitely check out those groups. There's a dev meetup up here in San Francisco, and certainly virtually any other project you'll probably find a meetup around. But with that, we've got a couple minutes for questions from the audience. Any questions? All right, shoot ahead.
So can a tokenized security or a securities token, for that matter, ever be a digital bearer instrument?
No. Not legally.
So the question is whether, a tokenized security be a legal bearer instrument, and we got that answer. Awesome. Next.
Nowhere I'd want to live.
Yes, sir.
The question is are there jurisdictions where you can have bearer instruments where there is no real world identity, whoever holds the instrument has the right. There used to be bearer bonds back in the day. It was a great source of money laundering. The answer is the vast majority of jurisdictions ban them. I know that there are some jurisdictions, I don't know offhand where they are, but they're very tiny sort of financial fraud havens. I would not base a business model or raise capital off of bearer securities.
Okay, so I've been looking into tokenized securities for a while, and from what I understand, there's fractional ownership of paintings, that's one market. There's also fractional ownership of real estate, that's another market which can be big. For instance, if some developer decides to go ahead and build an apartment building and decides to have investors that invest into the property actually own shares of that property, which always happens contractually in real estate, you could do it via crypto. But then again, the thing is, my question is, it's 2 questions. My question is, how will someone with an exchange be able to go ahead and list those type of security tokens because they need to be able to liquidate whenever they want to. And at the same time, also, I know that there's that prime broker problem where securitized tokens, security tokens kind of solve that issue of transfer and settlement and make things more swift on the back end when it comes to shares and transfer of ownership. So basically, the tokenized version of Microsoft stock, where somebody wants to go ahead and buy a certain amount, sell a certain amount. You know, that's another version of security tokens. Like, there are different types of security tokens. One that can be issued on the private business level, and then there's one that can be also issued on the higher level as far as dealing with stocks and bonds and whatnot. I mean, how do you guys, at which stage will there be a differentiation of the types of security tokens, and how you guys are going to be able to list that, and how people that decide to partake in the security tokens market will be able to go ahead and, even as an exchange, be able to go ahead and list those types of security tokens and liquidate them?
So they'll differentiate from the beginning. I think start with your last point about prime brokers, which is a great point. They'll actually become more important because most of these are going to be thinly traded. If you think about, let's say you have a private REIT or a private company, maximum of 2,000 shareholders per class of equity, you raise $100 million, it's a $50,000 unit of investment, $50,000 per security token. That's going to trade very thinly. And so especially if you're going to start moving positions, you're going to need a prime broker that can execute in different spots, and you're going to need to be patient because there's no way you're going to do $1 million trade like that. You're not going to find it, and if you do, you're going to move the price too much. And so I think prime brokers actually become more important, not less. There will be, I think you'll see a big move of market makers and arbitrageurs precisely because these won't have the liquidity of the public markets. There's a real opportunity for people to trade on asymmetric information that they get from research or knowledge, and there's a real value there. So today, for instance, in the private REIT market, people desperate for liquidity, if the NAV is 15, there are vultures that'll bid a 7, and people will sell because they're desperate for liquidity. When you've tokenized, you don't get a 15 on it. It's not a public market, but the 7 goes to maybe a 10, and as the industry develops, maybe an 11 or a 12, and there will be market makers that come in that arbitrage that. In terms of where it trades, all these different exchanges are springing up. My thesis would be that they start to specialize by type of asset. So debt is going to trade a lot more differently. Larger blocks is probably going to be far more liquid. It doesn't have limitations on the number of holders. It's a far deeper market already. $50,000 share in a private REIT is going to trade very thinly. The exchanges that handle them are going to have to service different relationship stack, different tech stack, different services they need to provide.
I think that's all our time, so warm round of applause for our panelists.